rate hike from the Bank of Canada will see some Canadians since January, particularly in BC and Ontario, paying more than $21,000 per year towards their mortgage payments. And this is going to put so many people over the edge of their finances. And in fact, today's rate hike on September 7th here in Canada is actually going to affect approximately 600,000 Canadians who have variable rate mortgages. And it's going to force them to start having to pay more every single month if they were on a fixed payment before, or they're going to be forced to put a big lump sum payment onto their mortgage so that they can bring their amortization back down to what they signed in their contract. And to top it all off, the Bank of Canada has said that rates are only going to continue to go up in their fight to bring down inflation. You have to watch this video to know how this interest rate hike is going to affect you and how it is going to affect the real estate market moving forward. Hey everybody, this is Jonathan Lerner from the Vancouver Life Real Estate Group and eXp Realty, bringing you all things real estate, and today the latest news of the Bank of Canada raising interest rates and how this is going to massively affect many Canadians. Today, the Bank of Canada increased rates again for the 5th consecutive time, raising them from January when the overnight policy rate was 0.25%. Having increased it now, as of today, they increased the rates another 75 basis points for a total of 300 basis points since January, bringing the overnight rate to 3.25%. And this is the Bank of Canada's, essentially their mandate, their number one goal right now is to try and bring back down inflation to their target rate of being between 2 to 3%. Now, in the CBC News release that they shared after the announcement, while Canada's inflation rate eased somewhat last month from its 30-year high of 8.1%, came down to 7.6%, the bank noted in its decision that most of that decline was due to gas prices, while the rest of the economy still saw a further broadening of price pressures, particularly in the service sector. That persistent underlying inflationary pressure is a big reason why the policy interest rate will need to rise further, the bank said, noting that it remains resolute in its commitment to price stability and will continue to take action as required to achieve the 2% inflation target. Woo! All right, that is a very aggressive stance, and they are telling us exactly what they're going to be doing for the rest of the year, right? They are saying that rates are going to continue to go up, and by the sounds of it, again, be aggressive with it. And they have 2 more announcements for the remainder of the year on October 25th and on December 6th. And very likely by that stance, they will continue to raise the rates. So your buying power will further get reduced, and we are very likely going to push into a recession next year. Now, why are they continuing to increase the rates? Well, despite inflation coming down, that's inflation as a total. Core inflation, which excludes energy and gas and food, because those are a little bit more volatile, core inflation is still on the rise, and GDP came out a little bit lower than expectations, but it is still very strong, and so people are still spending money. And the only way to really fight this is to raise the interest rates and force people to start to have to change their spending habits. So about 600,000 mortgages across Canada are going to be affected as a result of their trigger rates. So they've been on a fixed payment where they've been paying the same amount every single month, and even though they're on a variable rate mortgage. And what happens is when the rates change, a different proportion of what they pay every month, even though say it's $2,000, maybe they were paying $500 in interest before and $1,500 in principal. Now maybe the tides have turned quite a bit. Maybe they're paying $500 in principal and now they're paying $1,500 in interest. As the interest rates increase, more goes to interest, less goes to principal. So what that does, when you hit a trigger rate, basically 100% of your monthly payment is going to interest and 0 is going to principal. So now you're in breach of your contract with the bank, because now your amortization, you said you paid off your home within 30 years. Now maybe it's at 35, 40, 50 years amortization. And now they're saying, hey, you have to start paying more and pay down your principal to be able to get back with your amortization period. So the bank is basically going to give you 3 options. Increase the monthly payment that you pay by a certain amount, make a big lump sum payment so you can keep your monthly payments the same, or convert your mortgage into a fixed rate mortgage. And those are essentially going to be the 3 options. And what it will do is move you back into your original amortization period that you agreed to. These increases are really truly hurting people who are on fixed incomes, who don't have the opportunity to increase their income or their wages in any way. And wage increases are not coming for very few people. It's not keeping up with inflation. So as a result, it's essentially your requirements in terms of daily expenses are increasing, but you're essentially making less for the same amount of work you're doing because our dollar and our currency is being reduced in value because of inflation. So you're doing the same amount of work, but you're actually making less money because the cost of living is more expensive. And the latest increase, as of today, the 75 basis point increase by the Bank of Canada will see Canadians on average across the entire country paying about $200 more per month on top of the prior increases that they had before. Now, in BC and Ontario, the average mortgage is much higher. So looking at least a 20% increase minimum. And so people in British Columbia, where the average mortgage is going to be significantly greater, you're looking at a $350 to a $700 increase in your mortgage payment just with the last 75 basis point increase. Now, that's $350 increase would be about a $500,000 mortgage. Your $700 per month increase is going to be about $1 million mortgage. So that could be about upwards of $8,000 more per year that you're paying compared to last year. So a big difference in terms of people's budget and what they originally figured out that they could afford based off of their previous rates. Now here's a massive change. So take $1 million mortgage, which is very common. What is the change that have happened in payments from January to today? So January 2022, your fixed rates went from 3% to about 5.24% today, creating a difference of about $1,300 per month of what you would be paying. Now, obviously, if you've got a fixed rate, you got a flat rate. That's what you pay for the next 5 years. But if you got it in January versus today, you're paying about $1,300 more per day for that $1 million mortgage. Variable rate, this is the massive change, all right? Variable rates in January were about 1.59%, and today's rate, we're sitting at about 4.85%, resulting in about a $1,700 per month change in payments, equaling over $21,000 for the year if you have $1 million mortgage. That is a massive, massive change, and it's going to be very hard, especially for the people who bought something at the top of their budget, which is the vast majority of people. 90% of people, when they get their pre-approval, buy a home at the top of their budget. So this is really gonna cause people to start to struggle. Now, this is why the stress test was put into place, so that as interest rates increased, you've been stress tested that if rates were at 5.25%, that you'd be able to handle the increases. Now, we're at that level of that 5%, 5.25% interest rate. So this is that level that if we go beyond this, there's gonna be a lot of people that are gonna be struggling and are gonna be really worried about their ability to be able to pay their mortgage on a monthly basis. Despite these increases, our mortgage specialists and mortgage brokers that we work with our clients have been noticing a big increase in people getting pre-approved and getting their ducks in a row so that as soon as they see an opportunity, they can be able to jump on it. Or as soon as they see the market softening, that's their time where they're going to start looking very heavily. And even though the interest rates have been increasing and people's buying power has been reduced by as much as 20-25%, buyers are still lining up, and many have been waiting for several months now for this downward market and for this downward trend on prices to be able to jump in, because this is an opportunity where some people unfortunately are hurting financially as the interest rates go up, or other people are in a need where they have to move, and that's an opportunity to be able to get a good deal, whether you're a first-time buyer or you're an investor. And on the selling side though, a lot of homeowners don't want to reduce their prices, or it doesn't make sense in their mind to reduce it by 20% to be able to sell their home, so they're going to hold on to it. Many homeowners, I think it's 50% or a little bit more, actually own their home outright, or they owe less than 25% of the value within their mortgage. So they're fine. The increase in rates is not affecting them very much. Then you also have the other cohort that bought in the last couple of years, and they got a 5-year fixed rate where their rate is less than 2%. So they're in historically low levels rates for their 5-year fix, and they got a few more years left over. So the rate at which inventory would normally come into the market for the fall is likely not to come in at the same level. It will increase drastically in the beginning of September because a lot of listings in August would have been taken off the market and bring up fresh to make it look like they're new, but it'll be a little bit of a modified number because that's not really the case. So as a result, it's going to create more inventory challenges, which we've been having throughout the course of COVID, which is going to cause the buyers that are lined up to have to potentially compete and for prices not to drop further, maybe even plateau or rise in certain markets. And we're only on the cusp of a balanced market right now. We're not detached homes are the only thing that is very much in a balanced market, down around 11% or so in terms of the sales to active listings ratio. But townhomes and condos are very much hovering right around 20%, which is the top end of a balanced market, and heading into above that a seller's market. So we're at this cusp right now, and it's very interesting to see what's going to happen in September. And you know what? It's one of those things that as the market goes down, a lot of people get nervous and they step back. But as the market goes up, then they jump in because the FOMO, the fear of missing out, and taking advantage of the appreciation. But now is one of those ideal times to be able to really, again, like many other people are thinking about, getting pre-approved, getting your ducks in a row, so that if an opportunity comes up, then you have the ability to be able to jump on it. If you don't have those ducks lined up, then you're going to see something and then it's going to be gone by the time you get your ducks in a row. If you're worried about your current situation, whether you're looking to sell potentially or you are looking to buy, send me an email. My contact info is actually down below in the description of this video. Reach out to me. Let's connect. Let's have a Zoom chat. Let's grab a coffee and let's see what your situation is and what makes sense for you given where the market is heading. All right, thanks everybody. If you got value from this video, please make sure to like, to subscribe, and to click that bell to get notified of new videos that come up. And if you know anyone else that would gain value from this video, please click the share link and pass that link along to them. It would be much appreciated. Have an amazing day, everyone, and we'll see you on the next video.